All right, let's get right into it. The Federal Reserve just released its latest take on the economy, and with it, a huge decision on interest rates. So we're going to break down what they're seeing, why they're making this move, and, most importantly, what it means for the future.
So, this is really the core question on everyone's mind. As we look at 2026, is the U.S. economy on solid ground, or are there some cracks starting to appear? Well, the Fed's latest announcement is basically the most official diagnosis we can get. So let's unpack what they found.
Okay, first things first. We've got to look at the overall health of the economy. You can think of this part as its big annual checkup, We're checking the vital signs to see what's looking strong and where the weaknesses might be.
And the main headline coming from Fed Chair Jerome Powell is pretty positive, actually. He said the economy came into the new year on solid footing. Now that sounds good, but as we all know, the devil is always in the details. Because when you look closer, the economy kind of has a split personality right now. On the one hand, you see real strength. People are still buying things and companies or investing in their businesses. But on the flip side, there's some clear weak spots. The housing market, for instance, is pretty weak. And Powell also pointed out that the recent government shutdown definitely slowed things down for a bit. So yeah, it's a very mixed picture.
Now, let's talk about jobs. The unemployment rate is sitting at a steady 4.4%. And while the pace of new jobs has slowed down, the Fed actually sees this as a good thing, a sign that the labor market is stabilizing. It's not running red hot anymore, but it's not freezing over either. It's just cooling down to a more normal, sustainable pace.
Which brings us to the elephant in the room. The one issue that's really driving every single decision the Federal Reserve makes right now, inflation.
You see, the Fed has a magic number. It's their North Star, the target they are always aiming for. And that number is 2%. They believe an annual inflation rate of 2% is the absolute sweet spot for a healthy, growing economy.
And here's the problem. While inflation has come way down from its peak a couple of years ago, we're still not hitting that target. Total inflation is at 2.9%, and core inflation, that's the one that ignores the bouncy food and energy prices, is at 3.0%. We're so close, but that little gap is exactly what's keeping the Fed on high alert.
So what's behind this last bit of stubborn inflation? Well, Powell gave a surprisingly direct answer. He pointed the finger right at tariffs. He's saying the high prices we're seeing aren't because the economy is overheating. No, it's because taxes on imported goods are pushing costs up. And that is a really critical distinction to me.
Okay, so with that as the backdrop, a decent economy, but this weirdly stubborn inflation, what did the Fed actually do? Let's get into their big decision.
And the decision was to do nothing at all. The Fed's committee voted to keep interest rates exactly where they are, in that 3.5% to 3.75% range. They are officially hitting the pause button.
So why pause now? Well, their logic is pretty straightforward. It really comes down to three things. First, they've already cut rates quite a bit over the last few meetings. Second, they feel like policy is now neutral, meaning it's not really juicing the economy, but it's not slowing it down either. It's balanced. And third, because of that, they just want to sit back, watch the data as it comes in, and then decide on the next move. It's a very deliberate, strategic pause. Now, we have to circle back to this whole tariff thing, because for a central bank, this is a uniquely tricky problem. It's not something they deal with every day.
And let's just make sure we're all on the same page here. Tariff-driven inflation is not your classic too much money chasing too few goods kind of problem. It's a price hike that's basically forced by government policy, by taxes on imports. The Fed's normal tools, like raising interest rates, they aren't really designed to fight this specific kind of inflation.
So here's how Powell and the Fed are looking at it. They see the impact from tariffs as a one-time price shock, not some permanent upward trend. And because of that, it's way less concerning than if inflation were being caused by a runaway economy. Essentially, they're confident that once this shock works its way through the system, they'll be in a good position to handle whatever comes next.
Which brings us to the big, final question. What happens now? What's the game plan for the next few months?
Powell could not have been more clear about this. There is no preset plan. The Fed is not on autopilot. Every single decision they make from here on out will depend entirely on the data, what's happening with jobs, with growth, and especially with inflation. They're going to be flexible, they're going to be cautious, and they're going to make the call one meeting at a time.
And so that's where we're left. The Fed's grand strategy right now is patience. It's a wait-and-see approach. But in an economy this complex, with pressures coming from all sides, the biggest question of all is whether patience is going to be enough to hold off whatever the next storm might be.